Yesterday, I heard one of the single dumbest financial takes I've heard in a long time. Let's have a look.
I no longer think that it makes any financial sense whatsoever for most people to buy a house.
Buying a home makes zero financial sense? That's Graham Stephan's line. But let's test it with his own numbers. Is home ownership really some huge mistake? Only if you like throwing away equity and playing finance on hard mode. In the next 15 minutes, we'll unpack the flaws in Graham's argument, run the numbers on what buying a home actually returns, and show you how to use equity as both a safety net and an investment ladder. And by the end, you'll know exactly when renting is smarter and when buying sets you up for long-term wealth. But let's start with the obvious because incentives matter. Graham is a landlord. He also owns his home. He has multiple rental properties and actively has videos complaining about how investing in real estate at these prices isn't as good because prices are more competitive and it's harder to find good long-term renters. So perhaps advice that makes sense for the guy with a Lambo in his living room isn't the same that works for you, even if you're an active investor. If you bought during the ZIRP era, you have 3% mortgages. You can rent for less than a new buyer's mortgage and still profit. In his own example, a neighbor with a 3% payment, which comes to around $1,765, can rent the same house for $2,000 and make money, whereas a brand new buyer today might need $3,000 to break even. That's timing, not a universal law of money. But part of the reason landlords are offering that cheap rent right now isn't out of the kindness of their hearts, it's because a lot of the inventory is sitting empty due to tight economic conditions. So they're squishing down their own profit margins to try and get inventory filled near break even. Renting looks cheaper today for some markets because earlier buyers locked in ultra low debt and that helps them. The question is whether it actually helps you build wealth. Now let's talk about why homes are getting more expensive. Landlords, of course, will argue that it has nothing to do with these big investors buying up investment properties, and they blame government-backed programs. They're going to argue, as Graham does, that these mom-and-pop landlords are the bulk of investors buying rental properties. And that's true, this category is, but it's defined as somebody who owns less than 9 properties. 9. If you are trying to buy a family home, it does not matter if the person bidding against you is a megacorp with 1,000 homes or a rich guy with 8 homes. That is still bidding up the price. Mom and pop shops was this term that we used when little old first-generation immigrant parents and grandparents opened a local store, were the only employees and worked long hours, barely squeaking by. Using that term to try and evoke pity or relatability to someone who owns multiple rental properties is insane. To a first-time buyer, competing against someone who could own up to 9 rental properties is not mom and pop. It's a portfolio. And yes, he's right that corporate share nationally is small, but small portfolio investors can still shape local competition, and that nuance matters. When investors and landlords try and blame high housing prices on government affordability programs, they tend to mix up 3 different things. First, conforming GSE-backed mortgages, then down payment assistance programs like in California, and help to buy equity loans like the one referenced in the UK study. So let's explain what those actually are and why they are not responsible for these prices. Conforming mortgages means that the government will underwrite a mortgage at market rate, even when there isn't an investor to buy that mortgage on the other. So as long as you meet the credit requirements, down payment amounts, and income requirements, they will sign that mortgage. Because those mortgages are market rate, it doesn't put upward pressure on home affordability. The underlying amount of mortgage you're approved for doesn't change. Now, the other programs like down payment assistance or help to buy loans are different. Those programs provide additional loans for the required down payment on a house. That does bring people into the market as it makes homes that were a bit out of reach more affordable. But even then, it doesn't really impact the top line price unless it creates a bidding war well under your max approved mortgage. While most conforming mortgages require around a median of 15% down, there are 2 catches. First, lower down payments, as little as the 3.5% federal minimum, result in even above market rate on interest. And 2, anything below a 20% down payment is required to have private insurance on the mortgage amount, which protects the government and raises your cost. Now, both of those caveats actually mean that housing affordability is pushed down, not up. And even with down payment assistance programs, your overall debt load is considered in the mortgage. So taking one of those programs means you're approved for a smaller total mortgage size and not bidding up the high end of the market. So when Graham blames those programs, it comes from a fundamental misunderstanding of how they function. Those are different levers. Conflating them overstates a single cause and underplays other drivers that he himself lists, such as low rates, supply constraints, zoning, material, and labor. Let's do some math. We will use his scenario to keep it apples to apples. He talks about a $410,000 home, 20% down, a 6.2% 30-year fixed mortgage, add in taxes, insurance, maintenance, plus an opportunity cost of investing the cash elsewhere at 4.2%, even though that rate's already down at 4.08 and falling as rates get cut. Here's the fix. Equity is not a cost. In year one, you build $3,880 in ownership. That is forced savings that renters don't get. Now, Graham claims that renters save about 33% right now against the cost of a mortgage due to that inventory mismatch, which is true in some rare cases, but he also mentions later on himself how landlords are starting to raise prices again on current renters. But let's give him the benefit of the doubt here and apply that savings. In this scenario, that means you'd save an extra $662.93 each month that you could invest elsewhere. Now, assuming you actually had the discipline to do that, let's assume you also magically have that cash up front. That gives you about $8,000 that you could put into the risk-free rate. That risk-free rate right now is 4.08%. And just like the cost of the mortgage, we need to remove the cost of inflation, which is 2.7%, meaning our gain is just 1.5% in real terms. And this assumes that the rates don't get continually cut, which is the projection. On our $7,955.25, that means you'd gain an additional $117.82 each year in interest. Or if we factor in all the costs in the mortgage, including interest, which candidly still gets factored into your rent, your $34,207 would earn you $513.10 in interest a year, which is 7.5 times less than $3,879.80 in home equity that you have. And that doesn't even begin to factor in that $1 of equity is financially worth a lot more than $1 of savings. They are not equal when we look at wealth impact. But this idea that the interest cost outlay isn't something that you pay in renting is insane. Because landlords are in the business of making a profit, they will pass on all costs to you. However, they aren't in the business of lowering rents if they get to renegotiate their mortgage in the future. They just view that as putting more money in their pocket. Not to mention, this entire assumption is based on you putting down a full 20% and buying the absolute upper end of your approved mortgage and never renegotiating. So of course the year one interest costs will look insane because the equity benefit of a mortgage compounds over time, just like all financial benefit does. This is something that any finance guru should know. Now let's talk about these owner costs that he brings up. These owner costs don't vanish if you rent, they show up over time. Some landlords may delay their increases, but as leases reset, costs do flow through. Looking at payments on equity as a cost is not credible. Every mortgage payment isn't just money disappearing. Part of it pays down your loan. That's called equity. Equity is simply the piece of the home you own outright. And equity isn't just paper wealth. It actually gives you tools that renters never get. You get HELOCs, home equity lines of credit. You can think of this like a credit card that's backed by your house, but with far lower interest rates. If you pay down $50,000 of equity, you can borrow against that for things like renovations, emergencies, or even seeding other investments. Renters do not get that option. Right now, the average HELOC rate is around 7.8%, which sounds high historically, but it's a lot lower than the median credit card rate of 20.12%. You also have refinancing options. If and when rates drop, you can replace your old mortgage with a cheaper one and save hundreds a month. And sometimes you can pull that equity out as cash if it makes sense to you. Landlords, when they renegotiate, do not pass on savings. They take more profit margin than your next down payment. When you sell, the equity you've built up in your home rolls over into the next one. It's a ladder effect. And a starter home can eventually fund your forever home. Renters are going to start at zero every single time. So equity isn't just bragging rights. It's a financial Swiss Army knife. It grows your wealth, improves your credit profile, and gives you options renters never have. And the only reason to look at it on a raw numbers basis is if you've already got a ton of equity and multiple properties and a great credit history. Now, when we talk about equity as wealth building for everyday homeowners, that's one side of this. But let's talk about if you were an investor and your property has rental income. Equity works on another level. It transforms the home into a business. Here's why. Banks, buyers, and landlords like Graham don't just look at a property's cash value. They look at its revenue stream and get to apply a multiple. Say a duplex nets $20,000 a year after its expense. If the local market values rental properties at a 10x multiple, then that property is suddenly worth $200,000 in business terms, not just the land and bricks. That's an additional $200,000 of equity on top of the property value that you could borrow against, refinance, or sell into at premium. This is why landlords and developers obsess over something called NOI, net operating income. In a cash-only lens, $100,000 of equity built equals $100,000 of value. On an income lens with a 10x multiple, 20,000 NOI times 10 equals a $200,000 business equity that you can leverage. Because equity in a business asset can be worth far more than just the raw cash you put in, it's why owning a property with an income stream makes you wealthier on paper and in practice. Banks will literally lend you more against it. It's also why so many landlords want people renting right now, because they need break-even fill on their inventory, as they're often leveraged against the revenue from their properties onto multiple other properties rather than having robust down payments. So when does buying versus renting actually make sense? Let's forget the buying only makes sense after 20 years claim that Graham makes, or 28 years in his Vegas case. That's one market on a rigid threshold. Let's use a checklist. There's probably 5 simple questions for most homeowners. Time horizon. Can you hold for 7 to 10 years? And if you must move out before that, could you rent it out with 10 to 15% negative cash flow and still be okay? Affordability. Can you keep the pity under 25% of your gross income? That's your principal, interest, taxes, and insurance. That's much tighter than the max a lender will let you have. Reserves. Do you have 3 to 6 months of expenses saved up after the closing of this house? Can you buy below your ceiling? Can you get a target price that's 10 to 20% under your current max supreme? And does it meet a plan B? What is the rent to price ratio in that area? 0.6 to 0.8% monthly. It varies by market. But you want to know the fallback rentability of that property to know if you could still survive if you were forced to. If you meet all those, then it might make sense for you to buy. If you meet some of them, it might make sense for you to buy. The reality is we are also in a very different housing market than people like Graham came up in. They're used to a seller's market where you had no room for negotiation. The listing price was probably a price below where it was actually going to sell, and you had no room for things like inspections. Now that we're in a buyer's market, there's a lot more on the table as a buyer that you can do that is going to save you on this financing. Just off the top of my head, here's 2 tips that you'll see in this environment that can add up to a lot more savings than what Graham is talking about on the risk-free rate. First is prepaying points. Most lenders will let you prepay points, meaning you can pay fees upfront to lower the loan's interest rate. 1 point is usually about 1% of the loan amount and can reduce the rate by about 0.25%. Now, normally this isn't worth it when you factor in that rates are likely to come back down in the future and you can refinance anyway. But if this is your forever home and you know you won't move or refinance soon, then the math on lowering the rate can actually outperform the risk-free rate of return, since we know that cuts to the Fed funds rates are on the horizon. Meaning that this would also be more effective than Graham's renting model. Plus, as a buyer, you can negotiate something called inspection credits, essentially asking the seller to lower the price for fixes needed that you found during the course of inspection. For example, negotiating a $7,000 roof credit would be chasing a 0.125% rate change. These were things that were not going to happen during that hot market, but now in a cool market with a lot of high-priced inventory, you can push for concessions that will make it worth it. So you can still get that type of discounting that you need to bring down rates or bring down the overall principal price that is going to return at a higher rate than a 1.5% real return on a risk-free rate in a market where rates are dropping. So this turns, should I buy? Can I buy safely and still invest? You can always buy below your means and invest the leftover cash flow while building that equity, because equity is something you should have. So look, Graham is right on this. Mortgage rates track long-term bonds, not just Fed cuts. So don't bank on instant relief. What's likely is these rates shift over years and not months. Gradual rates easing from peaks, boomers downsizing and adding inventory, and builders normalizing the supply. But let's not forget that the start of a rate cut cycle is often also the start of tighter economic conditions, not booming ones. And that means idle inventory and mortgages as well. That's likely to bring back down prices and make it an even stronger buying market. So while the Fed rate takes time to work through the system to mortgage rates, it is likely on the horizon. Whereas Fed rates never really work through to landlord set prices, they just call that profit margin. So yeah, buy deals that work today. If the rates fall, that's upside. Graham treats almost every dollar of homeowner outflow as a loss, even in principal, and compares housing in an inflation-adjusted model to bonds and cash in a non-inflation-adjusted model. So using his $410K setup, you'd still build 3,880 of equity in year one that renters don't. Now, maybe it is well-intentioned advice, but it's not lost on me that it's coming from a landlord who currently has other videos complaining about his tenants, frustrations, and getting good rates for rentals, who also has good credit history, well-established equity, and multiple nest eggs he can pull from. He has the financial flexibility and setup that many don't. And is also coming from someone who has a home that he already owns and has substantial equity already. And so it isn't considering what might be right for you. Look, the American dream of a nest egg home ownership isn't dead. It's just not on the easy mode that investors like Graham came up with. You have to play the game smart to build wealth and flexibility that your family needs. Buy below your means, keep reserves, and let equity work quietly in the background. In a system set up for those who have equity and credit and income streams, you win when you own, they win when they keep you paid rent.